Hey everyone, Monica Jazik from RPI Education, and welcome to the Financial Freedom Summit. In this series, you will hear from 21 experts sharing powerful, little known wealth building strategies that 98% of people are not using. These interviews are packed with real actionable steps to help you fast track your financial freedom. So let's jump in with today's guest, Robinson Smith. Robinson, how are you doing?
I'm 100% yourself.
120%.
Oh, you got me beat.
I did. Thank you so much for sending over this bio. I'm gonna read this quick bio so the audience can know a little more about you. Robinson is the founder and CEO of Smith Manoeuvre Services Corp., which educates Canadians and professionals on the Smith Manoeuvre, a proven, legal, and surprisingly simple method to make mortgages interest tax deductible in Canada. A strategy once reserved for the wealthy, now available to everyday homeowners. The approach enables Canadians to pay off their mortgage faster, generate annual tax refunds, and simultaneously build an investment portfolio, all without requiring any new cash out of pocket on a monthly basis. Welcome, Robinson.
Thank you. Thank you.
And thank you for doing this. I know we know each other very well. We've worked closely together before, and I absolutely love the Smith Maneuver for our Canadian clients. We are encouraging every single client that comes into RPI Education to utilize the Smith Maneuver. This is absolutely genius. I love it. I know Americans, they have a little more tax advantage sort of strategies that they're able to utilize with their mortgages, but before this came along, there's really few other options that Canadians really can do to get ahead with their mortgage. Isn't that correct?
Well, that is correct. You go in, you finally want to take control of your personal finances. You go speak to an investment advisor or a planner, and you ask them, what can I do to get ahead in these very, very difficult times? And you'll hear the same things regardless of who you sit down with. Max out your registered contributions, pay down as much as your mortgage as possible, get rid of your credit card debt, get rid of your car loans, invest more into open accounts. And the challenge with all of these traditional pieces of financial advice is that they all require more cash from the client. And these days, as we know, there is very little, if anything, left over at the end of the month. So if we are going to improve ourselves financially using these conventional strategies, we either have to get a second job or we have to downgrade our lifestyle. And neither of those are particularly attractive. So what the Smith maneuver does, which is different than all the other strategies that are out there, is it reduces your tax bill. Great. It helps you get rid of that expensive non-deductible mortgage debt faster. It's the largest debt most Canadians are ever going to take on. So we get rid of that faster, and we start to build an investment portfolio that otherwise simply wouldn't exist. And it doesn't require any additional cash flow from the homeowner's pocket on a monthly basis to take advantage of this. So it really is a game changer for Canadians who maybe they're doing okay, but they just want to get ahead, but maybe they're struggling. Life is expensive with taxation and the cost of housing and mortgages, etc. So it is a game changer.
And even if people are doing okay, not that anyone really is, especially with the interest rates increased, personal residences are taking the biggest chunk of people's income. It is just, it's always to reiterate that your house really is not an asset. It is a liability. And I think the Smith maneuver really kind of does the whole Robert Kiyosaki, sort of terminology here and really converts your house from being a liability and converts it into an asset because now we really are using this type of leverage. We really are using this structure that we have to live somewhere. How can we pay down our mortgage faster, make it tax preferential, as well as not, like you said, have all that extra cash to have to put into it to get ahead.
Yeah, we Canadian homeowners we're faced with two options. We can either buy a house and pay it off gradually over 25, 30, maybe even 40 years, and finally we retire, clear title to the house. We finally paid off that mortgage. We've spent millions of dollars doing so. No mortgage on the house. We hit retirement, because we've been concentrating on paying out that mortgage, we don't have an investment portfolio. We can't afford to retire. So we either have to keep on working, or we have to sign up for a reverse mortgage, or we have to downsize. All of these events that we wouldn't necessarily choose to undertake. So there's one option. Or instead of using our equity when we retire by getting a reverse mortgage, for example, let's use our equity now and invest it right away when we're as young as we're ever going to be. We all know that the longer you're invested, the better off you're going to be. So start now. And that's what the Smith Maneuver allows one to do.
That is amazing. That's very, very well said. I love that. So tell us really more about how you utilize the Smith maneuver to kind of create freedom in your life. And why do you think this strategy is so underused?
Well, firstly, as I mentioned, as far as creating wealth and freedom, the strategy, it frees up hundreds, if not thousands of dollars on a monthly basis to get invested, which then generate tax deductions and improve your tax bill. So the earlier on you start with this, the better off you're going to be. And I was fortunate, of course, my father, who developed this strategy back in the mid 80s, fortunate enough to be his son. So I learned about it when I had my first home, and started then. And my sister, my other relatives, friends, etc. So really, the sooner you start on this, the better off you're going to be. It's not, to answer your second question, as utilized as maybe it should be. Uh, as I mentioned, this was developed back in the mid 80s. We're going on 40 years when my dad Fraser developed this, but he didn't do a whole lot of marketing. When he came up with the strategy, he was a financial planner. He put his own clients into it for 15 years. Didn't market, didn't want anyone else poaching his clients, if you would. Now he came out with his book. Got a copy right here for you. This came out early 2000s, but he didn't market that for very long either, because he came out of retirement from planning to go back into retirement or back into planning. So, and I joined him in 2006. So there hasn't been a lot of marketing or trying to generate public awareness with the strategy until I sold my investment advisory back in what was the middle of 2018, I believe. And I came out with my own book at that time. Got a copy of it here for you. This is when I started to really, I sold my business because I wanted to help a mass number of Canadians, not just one family at a time, as I was as an advisor. So I sold the business, came out with the book, and put together this network of Smith Maneuver certified professionals. We're up to about 200 now across the country, and that's really when um, the big marketing push, general awareness towards Canadian homeowners started. And we're seeing some amazing results with the number of Canadians who are now hearing about the strategy, looking to find more information or get put into the strategy. So now we've really sort of hockey stick the awareness over the past few years of the strategy.
Yeah, maybe this is the perfect timing. It's been a long time in the making. The strategies existed for maybe now really is the time that I think all Canadians should be utilizing this strategy. It's just so helpful for people and really kind of helps people get ahead.
Yeah.
You mentioned that you had an advisory firm before. Tell us like more what you were doing to build wealth before you started making the Smith Maneuver your main point of focus. And what was that pivotal moment that happened in your life where you decided to make the change over to focusing primarily on the Smith Maneuver?
Well, we can go back quite a number of years to when I was trying to figure out what I wanted to take in university. My father being who he was, I was going in with a business bent, and I had one more elective to sign up for. And I asked Dad, I says, I got one more elective. I'm kind of thinking about taking a language. And he says, well, which language? I thought, oh, maybe I'll take Japanese. Why do you want to take Japanese, Rob? Well, everyone's studying Japanese. Well, then maybe you don't want to study Japanese. Why don't you study Chinese? So I looked at him incredulous, like I've heard Chinese people speak. I can't make my voice do that. I was just a kid at the time, but I took it and I loved it. And because I took Chinese at university and an economics degree, I spent, 8 years on and off in China. My latest role when I was living in China in Beijing was as vice president of an investment bank, which was headed by the former Canadian ambassador to China. Um, but I wasn't in the personal sort of let's really build my personal wealth mode. Uh,
Mhm.
I was doing okay on the financial side of things, but I didn't really have that mind at that time. My dad said, back in early 2006, your mom misses you, so you got to come back to Canada, and I'll show you what the Smith Maneuver is all about. Because he was doing it for years, but I never took an interest in it. So I did that. I came back. I started up my own advisory next to my dad's, and he told me all about the strategy. He trained me up, and when I really started taking an interest in my own personal finances, seriously, was when I started taking on clients and just hearing the stories of these people. By the time I sold my business, I had 500 families as clients. But the more people I met early on in my career, the more misinformation I saw people had about personal finances, uh, bad advice. I had one guy, I met with him, and I looked at his information. I said, okay, well, you got $30,000 worth of credit card debt. And I noticed the limit on all your credit cards is $30,000. So he'd borrowed every penny he could. And I asked him, well, why are you maxed out like this? And I was expecting to hear, well, life's tough. I can't afford anything more than the minimum payment. And he looked at me and he says, well, with all these credit card companies willing to give me money, I'd be stupid not to take it. So he had $30,000 paying 19.99, 24.99. And he was the vice president of a company that many of you would realize that this company. So just the amount of misunderstanding, the lack of financial education, and that's when it flipped for me. Like, here I am helping other people create wealth. I got to get serious about my own, right? Because I just saw so many people who were in trouble, and they didn't know they were in trouble. They had no idea. A lot of people did, but some didn't, right? So that's when it really flipped for me.
Yes, it's amazing until you start working and really kind of listening to other people's stories, that you start realizing how people really do not understand finances and how poor even people who work in the industry, their financial literacy is. I know
Yeah,
people
and
that own insurance companies that don't even believe in utilizing insurance as a wealth building tool. It's
and for a lot of Canadians who don't have this fulsome understanding of personal finance, it's a lot of the times it's not their fault, right? I mean, maybe they did take an interest, but they asked the wrong person for financial advice. And how do I buy a car, or how do I buy a house? And they're just learning from the wrong people, even though they have an interest. We learn about money at such a very early age, and it's not in school that we learn it, it's from watching our parents. And if our parents are just throwing stuff into the grocery cart, not looking at prices, then that's what we do when we grow up. So it's a real challenge. We need to start educating people in personal finances a lot earlier than we do formally, as far as I'm concerned.
Yeah, it's great that you took to your dad and listened to his advice, and it sounds like you said your sister did as well. Because not everyone always listens to their parents or their advice. It would have been interesting to see if you had another long lost sibling who went against it and how that worked out.
Yeah,
Maybe
do a comparo.
well, I think when, like you said it well too, when you're working abroad and you're just working, we're not always, and the audience that will be watching this will be various ages. We're not born with this knowledge and this life experience, and everyone goes through different stages and different ages. And sometimes things do not resonate with you at a particular age until like these pivotal changes really happen in your life. And then it's ages and stages. And all of a sudden, and I notice like for myself, geez, every year I get older, I think my parents were right about a lot of these things that I really kind of argued against. So, kids, anyone watching this, remember your parents might have an inkling of what they're talking about if they're getting the results that you want to be getting.
Yeah.
So it's great that your dad was getting these fantastic results for himself, for his clients, that he shared that. with his family. Did you see a rapid progression in paying off your mortgage on your first primary
Oh, yeah.
residence?
The thing about the Smith Maneuver is, um, you know, when someone reads the book or talks to someone who knows what they're talking about and they finally understand the strategy and why it makes sense, how it works, why it works, etc. Um, the 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 passion for paying down this expensive non-deductible debt rises because you start to see results right away. When you're just paying off your mortgage conventionally every month, you're like, oh, cutting that check for $3,000 or 3,500 or 4,000, whatever it is. And it's, oh, every month. But with the Smith Move, it's like, yeah, okay, boom, let's go, boom, boom, boom on a monthly basis. And people will start to find money from other sources, right? They'll sell 3 of their 4 guitars and they'll get a few $100 and they'll pay it down against their mortgage, pull it back out and get it invested and create those tax deductions, create that portfolio. So there's an excitement that comes with paying down your mortgage when you can see results, right? And that's what happens.
It really is. I remember if it wasn't for this type of leverage, I remember when Manulife One first came out, we were actually that consolidation mortgage we got. That's what gave us the down payment money to buy our first 3 rental properties. And it really got us going. And I was really grateful. And even learning about how that worked and watching that number go down, 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 because all the rental money that came in, you could put it right back in. And
Right.
it was amazing to see, how you're actually using this line of credit. And I remember the advisor's advice, and this is before I knew about the Smith maneuver. But he's like, whatever you do, do not go out and buy a Porsche with this money. So he was really worried that, and this was probably the only really good piece of advice that this traditional financial planner gave us. Like, thank God, this is like the one right thing he probably told us to do. And
Yeah.
not the Porsche. We figured that out already. Um, but he was concerned because a lot of people, they will, like you said, like that client borrow money off consumer borrowing and credit cards and high interest, or even lines of credit. Like people will use their line of credit not to consolidate debt or to invest, but to go on a vacation. Like, unless you have an income strategy or a stream that you're planning to do, maybe if you took it, borrowed it, and put it into a business or something, because you have this plan to generate more income. But if we're just consistently putting it in to consumer debt with no plan to pay that back or make more money, you're just going to be digging a bigger hole for yourself.
Yeah, and the Smith Maneuver relies on having the right type of mortgage. And a lot of the different banks and mortgage lenders will offer the right type of mortgage, but they're all different. They function differently, benefits and it's not so beneficial stuff about each individual one, that sort of thing, which is why it's so important to speak with a Smith Maneuver certified professional mortgage broker who can say, for your situation, this one's the best. But there's the Manulife One, there's Scotia, there's TD, all these different banks have them. But the challenge is that when you're dealing with someone who works for the bank, for RBC, and their job is to sell RBC mortgages, and they will put you into the mortgage that you could use for the Smith maneuver, but they don't tell you about how to properly use
Hmm.
this tool that they're giving you. So a lot of Canadians have the right type of mortgage already, but they don't know it. And they're using it wrong. Why? Because they go in, they get this mortgage from the mortgage advisor, great, sign the dotted line, they make a few mortgage payments and they notice, wow, I've been paying down my mortgage just a little bit, but there's this line of credit limit which continually increases each month. That's about a 5 series payment. Perfect. I can go get a BMW. And
Hmm.
whenever that new equity is available to them to utilize, they use it to buy a car, a motorcycle, go on vacation, fancy dinners, that sort of thing. So all they're doing is paying down expensive mortgage debt on one side and replacing it with expensive consumer debt on the other side. And it's non-deductible debt. And the asset they buy depreciates, disappears, they still got the debt. And this is why large part of the reason why Canadians have such a consumer debt problem is because we're not being educated on how to use these tools that are out there.
Absolutely. We want to have our assets paying for our liabilities. That is the only way to really do that is rather than going out and buying these things, your liabilities with cash or worse with credit, because once it's gone, and they're all, like you said, depreciating. So when you have your assets bringing in income every month, you definitely want to have your assets paying for your liabilities. And in an ideal situation, how could we make these liabilities tax deductible as well before we pay them off? So that's always a fun little game, fun little
Yeah,
financial literacy game as well to do as
yeah,
well.
yeah.
So let's get into it because I do have this conversation with mortgage agents a lot who are not Smith Maneuver certified. I said, "Are you Smith Maneuver certified?" And a lot of people or agents say, "No, but I don't need to be Smith Maneuver certified because I understand how it works. And I have the products, like you just said, to put people into so they could, start using this and just Smith Maneuver themselves." There's quite a bit more that goes into it than just using an all-in-one consolidation or a Scotia Step account or any of these things. Can you briefly walk us sort of through the strategy of how people can use the Smith maneuver really to fast track their wealth?
Yeah. Yeah. So, like I said earlier, it relies on having the right type of mortgage, the right mortgage product. And for anyone who's interested in the Smith Maneuver, if you're talking to a mortgage professional or any other professional who says they know the Smith Maneuver, ask them if they're Smith Maneuver certified professional. If they're not, go to our website. We can connect you with someone who is. It's so terribly, terribly important because we're dealing with a major part of your financial security, and you do not want to get it wrong. You absolutely do not want to get it wrong, either the financing, the investing, the tax reporting. But basically, that being said, with a readvanceable mortgage, it's like a traditional mortgage, which you're going to pay over 25 years. This one lump sum of money you're going to pay off, but it's got a line of credit effectively, which is attached to that loan. And the two sides speak to each other. So whenever you make a mortgage payment, say $3,000, let's say 2,000 of that goes to non-deductible interest payment to the bank. That's the price you pay for borrowing that money to buy your house. But $1,000 does reduce that principal. When you reduce that principal by $1,000, the line of credit says, "Oh, you paid it down over here. I'll let you borrow it over here." You take that $1,000 and you invest it. You don't make a car payment. You invest it. Stocks, bonds, mutual funds, ETFs, REITs, mix, investment real estate, all these different types of assets, which will allow you to deduct the interest. Because you're borrowing to invest with a reasonable expectation of generating income, at tax time, you can deduct the interest that you've paid on that balance on the HELOC. But you do that every month. Whenever it goes down, you pull it back out to invest month one, month two, month three, month four. Tax time, you send in your tax return. The CRA says, "Oh, we took too much off your paycheck every 2 weeks. You've got all these deductions we didn't know about. We owe you money." So they send you a tax refund. You take that tax refund, which otherwise you wouldn't have received, you make an extra payment against your mortgage. And whatever you pay down with that, you can pull that out to invest as well. And then year two, on a monthly basis, pull it out to invest. You declare on your taxes the deduction, and your refunds get bigger and bigger and bigger each subsequent year. So that's why we're able to get rid of that non-deductible debt much faster. For a typical mortgage these days, we're generally seeing about 3 or 4 years taken off the amortization of that mortgage from 25 years to 23, 24, 22 years or whatever it is, and a net worth improvement of about $300,000 to $400,000 simply because you're investing your equity as fast as you're creating it and claiming those tax deductions. So, and all it does is use the mortgage payment that you're making anyways. That's all it needs.
Mhm.
But there are accelerators that we can apply to the strategy. There's the cash flow diversion, there's the debt swap, the drip, the cash flow dam, the prime, the pump. And to what you said earlier, a lot of people will say, "Okay, I want to do the Smith maneuver. I gotta get out of the mortgage that doesn't work into one that does." And because the value of their home has gone up over time and the mortgage balance has come down slowly, albeit over time, maybe they've got $50,000, $100,000 or more that they can pull out right away. So they get refinanced into the right type of mortgage. They pull out $100,000 and they go buy their first investment property. They make their mortgage payment on a monthly basis like they would before, and they're pulling out that thousand, whatever it is, to invest. But now they've got this investment property. They can employ the cash flow dam accelerator because you put a renter in there. They send you $3,000 each month. What most Canadians do is that $3,000 will go into a bank account that's dedicated to their new rental property. And then 2,500 or 3,000 will come out to service the expenses on that rental property. Because you got property tax, you got the mortgage, you got all these expenses. So money comes in and money comes out. But what they don't understand is that when they get that $3,000 from their renter, they can first pay down their own mortgage against the house in which they live. So they're making their regular mortgage payment. They're also making an extra payment each month of $3,000. When that becomes available on that line of credit, because whatever goes down, it comes up, they pull it out and then they service the expenses on that rental property. And the borrowing to service the expenses on the rental property is tax deductible because you're borrowing with the reasonable expectation of generating income, which is the rental receipts each month. And so if you're prepaying a mortgage by $3,000 a month, this is where we're seeing a 25-year non-deductible mortgage gone in 5 or 6 years,
Mhm.
right? So, and then the other accelerators are also equally as powerful depending on how you utilize them, right? So really, it's this, we're creating equity whenever we make a payment. Whenever we pay that mortgage balance down, we're creating equity. And like I alluded to earlier, the more equity I have, so the longer I've been making my mortgage payment, the more equity I have, the more I'm losing. Because if I'm not putting that equity to work, it's earning me 0%. Not only that, it's negative percent because of inflation. So I can either earn negative return on all this hundreds and hundreds and hundreds of thousands of dollars in this house, or I can earn 5, 6, 7, 10%, maybe more by getting that equity invested as fast as I create it.
That's incredible. That's incredible. Now, most mortgages, like traditional mortgages, have prepayment limits that you can only do. Let's say you can only do $100,000 a year. When you're in these consolidated products or these more open products, say if you have a big windfall and say I have 250,000 I pulled from a refinance or something as a real estate investor, am I able to put that amount down or do those limitations still apply?
Well, this is why it's so important to speak to someone who knows what they're talking about, Smith Manoeuvre certified professional, because even, ignoring that windfall for a moment, even, one bank will say, hey, you can only double up your payments, right? Or your annual prepayment allowance is only 10% or 15%, not 20% as it is over there. So there's a lot of different factors going into all these different types of readvanceable mortgages from the different lenders. Um, some you hit your annual prepayment allowance and they don't want you to pay more at all, right? Until the year ticks over. But what the wealthy will do, and I think I use this as an example in my book, is if I've got a $400,000 mortgage on my house, and over here I've got $400,000 in cash, maybe it's from investments or inheritance or whatever it is, what I can do is I can pay out that mortgage entirely. Forget the penalties, I'm going to pay them, right? I do the math, right? I ask someone to do the math, pay it out. Now I have clear title on that house, but
Mhm.
I borrow it back and then I invest it. Because a lot of people, same thing with an annual $10,000 bonus from work. They got the cash in their hand. What do I do? Do I pay down my mortgage or do I invest it? And the answer is you do both. You get rid of that. You got non-deductible debt. You want to get rid of it as fast as possible. Pay down your mortgage, pull it back out, and then invest it.
And I do believe that with the Manulife one, I don't know, but that's the only product I've ever used, that you are able to, the way that we were doing it anyways, the consolidation account, is that you could like make it so you keep making those payments and you don't no longer have a mortgage. You just have a complete line of credit and then continue to invest that
Yeah,
amount and grow that
yeah. See,
wealth.
Manulife has a unique product, and a lot of our SMCP mortgage brokers will use the Manulife one because it's very functional, it's very flexible. But to clarify on what you just said, I know you know the difference, Monica, but maybe some of people on this might not click right away, is that it doesn't matter if you have an amortizing loan with principal and interest payments or a HELOC, which is interest only. That is not a top level consideration when you have non-deductible debt because the debt is still non-deductible. All that does is tell the borrower what the terms are for repayment, if any, right?
Mhm.
You have to make P&I payments over here, or you only have to make interest payments over here. But you can combine these to really maximize the power of the Smith maneuver. And that's what our SMCPs do for their clients.
And this is the difference between certified Smith Maneuver professionals and regular mortgage agents if they want to do this tactic. And also, it's also important, I think, for and I've worked with some Smith Maneuver professionals before, and they're very, very thorough. And one thing we always do with people at RPI is send them to a mortgage specialist to really create what we call their mortgage plan. And I think the professional knows about the client and what is important to that client, is and what they do for a living and how much income they're bringing in and what strategies they're using that's going to be able to pay down more faster, or is going to be able to bring in higher cash injections, or is it just going to be more, general wages that are tend to
Mhm.
come in and they want to borrow from this particular strategy. I think that really kind of allows them also to really design that whole Smith maneuver plan on top of the mortgage plan,
Yeah.
and then make sure that aligns them with the right lender.
Yeah, absolutely. I mean, the discussion is not what is the best rate you can get me. It's how can you create the most wealth for me? And if you're a non-SMCP mortgage broker, you're going to say, I can get you this rate. And maybe an SMCP mortgage broker to get you into the right type of product cannot beat that rate. But I don't care. I'm going to pay 40 extra dollars a month for a mortgage which allows me to create 300, 600, $1.4 million of additional net worth. Absolutely. I'll pay that up all day long.
I think
So
that kind of goes
it's
into
important to be
that
a
next
mortgage planner,
question.
not just a mortgage broker, really.
I think you sort of answered the next question, which really is how does the strategy go against conventional
Yeah.
financial planning advice? Because I think all I hear is, I need the lowest rate. I need the lowest rate. I need the lowest rate. And that's what they're mainly focused on. Like they're not even considering there's this whole wide world out there of what you could do with these products. They are just so worried about getting the lowest rate.
Everyone's just conditioned that the lowest rate is the best mortgage. And almost every time the lowest rate is by far the best mortgage because someone, a mortgage broker is focused on rate. They get their clients the best rate. They're known for that, whatever it is. Every once in a while, a deal will come along and wow, this is a really low rate. Great, I got you the best rate. And then guess what? You know how many people break mortgages? It's very, very common. They break mortgages because they have to, or they want to, or they're moving, or whatever. And when that time comes, what do you mean I got a $20,000 penalty, a $30,000 penalty? Well, that was one of the conditions of getting you the best rate. Best rate very seldom is the best mortgage.
Absolutely. No, I totally agree. And you know what's really scary is I know that pretty soon we're waiting for a rate adjustment to happen. It has not happened for a while. In Canada and the US, we're all waiting for rates to come down. But I think we have to people are really waiting for them to be 1, 2% again, 0%. Like, I don't think that's ever going to happen again. I think people are going to have to really get kind of used to the olden days, before we are having the 0 and 1%, maybe more like what, 5, 6%
Well,
interest?
this is the nice thing about the Smith maneuver. You know, we'll see on the internet forums, which are a rat's nest of misinformation, but we'll see the Smith maneuver doesn't work in high rates. And then we'll see another post, the Smith maneuver doesn't work in low rates. Well, guess what? It works in all rate environments. When there's a low rate, it's a low rate environment, we have maybe $1,100 to invest each month. But our tax refund is smaller than it would be with a higher rate. Now, when rates go up, we have instead of 1,100, maybe we have 1,000 or 950 to invest each month, but our tax refund gets bigger. So we're getting benefits on both sides of the coin here. So to wait for rates to change in what you perceive as your favor is to forego 6 months, a year, 2, 3 years of investing $1,000 a month, enjoying those tax deductions. I would rather get in now and pay 4.5 or 5 or whatever it is at any given point in time and have $24,000 invested over the next 24 months versus wait until the rates come down and then get started. I missed out on the most powerful 2 months of my investment career, which are the first two, right?
Yeah, like I always say, wealth building never stops. And when something's right, something else is wrong. Everything
Yeah.
is give and take. Like the rates are going to go down and then the prices are going to go up. And then everyone's going to be saying it's too expensive to buy. Right now, the rates are up and the prices are down, and people are saying it's not the right time to buy because the interest rates are too high. I think they're forgetting when the rates were super low that the prices were like 3 times higher than they are today. So it's very rare that everything makes sense
Aligned.
and aligns, like,
Yeah.
which I always say, wealth building never stops. We have to learn to continue to grow because what is the, I think, what do they say, the eighth wonder of the world
The
is,
Smith maneuver.
yeah, the Smith maneuver after compound interest. It should be. You should get
Yep.
it written in there. But compound interest, like Albert Einstein said, that's one of the, the natural wonders of the world. And it's it really is amazing. We always just got to keep building and growing and figuring out what can we do at this time, to continue to move forward. And that's a huge purpose of this summit, is really for people to learn new financial tactics and strategies and be able to implement them to their own wealth building practices so we can help people really, really get ahead.
Yeah. But you got to start. You got to start. That's
You
the key.
gotta start. Never too late or too early, right?
That's right.
So if you were starting from scratch today, you had no followers, no capital, no connections, what secret move would you use to get ahead fast?
Oh, uh, well, that's a difficult one. I don't know.
Did I stump Robinson?
You stumped me. Um, I guess, well, I guess whatever I whatever I did to earn money, like if I just walked out of the forest one day, managed to get a job, I would focus on, as they say, paying myself first. I went so many years um, not paying myself first. I pay the expenses, the bills, and all that, but I didn't focus on retirement. Was too far away. It's so far away. I don't have to worry about it. That's what I would change. And because as we know, the sooner you start, the faster your portfolio grows. And what a lot of people maybe don't maybe don't understand, or maybe they have an inkling of, is that the more money you have, the more different types of investment opportunities open themselves up to you. And to get started, to build that portfolio where you do now have an opportunity to invest a chunk of 25,000, which is the minimum for some opportunities out there with better returns, less risk, or whatever it is, you know, the sooner you start, the faster your money grows to the point where these investment opportunities open themselves up to you, and you can start expanding your horizon of what you invest in and what you get into, whether it be private placements or REITs or private lending or investment properties, that sort of thing. It's you got to have the capital to get into that game, right? So start
Absolutely.
as early as you can to get enough capital so that you can start playing that game.
I love that. Yeah, so many people forget to pay themselves first. They pay everyone else and then pay themselves last. And then
Yeah.
and then that investment money is never there. It's never there. And it's a really great habit for people to get into, especially young people, to when they're starting out to do that. What is the biggest lie or misconception about wealth building that keeps 98% of people stuck?
Well, it revolves around debt. Uh, when when you ask a typical Canadian how they feel about debt, they're gonna, ew, like the big dark cloud hanging over their head, right? debt is bad. All debt is bad. It doesn't stop them from acquiring debt, but all debt is bad. You approach a wealthy person and say, what do you think about debt? They're going to say, well, which kind? Because I got two answers for you. Deductible debt, love it. Non-deductible debt, not so much. The wealthy use debt to their advantage. They will say, I don't have enough debt today. I need to go borrow more deductible debt and get invested. Um, and that is what holds a lot of people back, is this inertia that debt is bad. And um, their aunts and uncles and grandparents telling them, if you buy a house and get a mortgage, you pay that off completely by the time you hit retirement. And great, because it's bad debt. That's the right sort of mindset. I should get rid of it as fast as I can. But they're missing half the story, because you can replace that bad debt with good debt like the wealthy do.
I love that. That is so true. I was talking about that actually with a friend of mine just the other day about a van. He was surprised that they're selling a minivan for that was like a 250,000 kilometers on it. And the person, they had all these offers to buy this minivan from like $12,000 for them. I don't know how much longer this car is going to run, but people will pay a big chunk of money. And this is not even for a good vehicle. Imagine all those people who are paying
Mhm.
70, $80,000, that big chunk of money just to buy a new vehicle. Because of course everyone likes to have all the bells and whistles on there.
Mhm.
Sometimes the vehicles aren't even that great of a brand name. It's just pretty run of the mill, but they will overpay to have that. And I always think about, our strategy, like what you're saying about tax deductible debt and cars. Why would you take $70,000 instead? I would take that money, invest it, and with the return that I'm getting off of that money, that would go towards, for a car lease.
Helping with the payment.
And it pays for the entire payment for the car lease, often not even the entire, like often there's money left over, and my lease is 100% deductible. That goes
Yep.
that as a
Structure it right.
business expense.
Yeah.
Our family car do the same thing. It's about like a $50,000 car or something, or 60 is a minivan, like for a brand new minivan. Take that, we stretch out the payments as long as possible for financing. Once again, it's just as a cheap payment. We have a brand new vehicle and investments paying for it. And then we just pay for those, and the finance rates are 50% tax deductible off personal expenses. So
Yeah, the challenge is people naturally don't want to wait until they're in a position to have investment assets service their expenses, right? Waiting sucks. Bill just got a new Camaro. I gotta wait for mine. Well, yeah, maybe you do, right? But if you've got all these different investments, maybe you got this pot of investments which is paying for your car. This pot of investments is finally making a mortgage payment for you. This pot of investments is your fund money. It's throwing off fund money every month, right? That stays with you. It doesn't disappear if you take the same chunk of cash and throw it at that consumer item. Disappear.
amazing, yeah. So true. And then the funniest part is if people are looking to do this for big, huge expenditures like cars, that cars are the second most expensive thing that people pay money on. Real estate is the first. Is that you get to drive a brand new vehicle and there's no problems because everything's warranty, they have to take care of that for you. And you could stretch that out for like 5, 6 years, but who's knocking on your door at year 3 or 4
Mm.
going, want to do a trade-in? And you're like, if you could keep the payment the same, I don't care. Yes, let's do it. Because it's a tax write-off. You can have a great thing, and you know that your assets are paying
You got
for
it covered.
this liability. Because I don't have time for problems and car failure and all that stuff. Life's
Yeah.
life's too busy. There's too much investing to be doing to be worrying about that stuff. What do you see the top 1 to 2% wealthiest people and families doing consistently that the rest of the world ignores or avoids?
Um, well, I have seen a stat that the vast majority of the world's wealthy people are real estate investors. Of course, it's not an easy game to get into if you're just an average Canadian. It takes work and preparation and all that sort of thing. But um, really, I think it's this we've your average person has set up their finances opposite to the way the wealthy person has. Um, what we do typically as Canadians, we put our consumer items on our credit card, and if there's any money at the end of the month, maybe we'll invest it. Maybe, right? So we're investing with cash, and we're buying our consumer items on credit. And the wealthy will do it different. They'll or those on their way to becoming wealthy, they'll take the cash that they have, and they'll buy their groceries with the cash. They'll use credit to invest because they understand that the deductions are a benefit to them. They're still getting that money invested, whether it's cash or credit, but they're generating tax deductions, and they're not going into consumer debt, which is a killer. Whether it's a personal line of credit at prime plus 4 or 5, or a credit card at 19 or whatever percent that they're at. It's a mindset of how I'm going to manage my money. And the wealthy do it very differently than the 90% of 95% of other people.
Yes, and that's what we want. We want to do this shift to teach these concepts and wealthy ways of thinking to people so we can really fill that wealth gap. Because
So,
there's
so
still
here's yeah, so here's an example of that is someone has $30,000 and they want to invest in a new business with $30,000. But at the same time, their car blows up and they need $30,000. What someone who doesn't have a lot of education will do, they'll take their cash, they'll start their business, and then they'll go to the bank and get a car loan for $30,000. Whereas they should have done it differently. Oh, okay, well, I need a car. It's going to cost me 30,000 bucks. I got 30,000 cash here. Boom, I bought my car. I can borrow $30,000 and start my business. And it's a big
Mhm.
difference in deductibility.
Absolutely. Absolutely. It's just a little bit of juggling.
Yep.
And like Tony Robbins says, these 2 millimeter changes is really what it takes just to change lives and to reconfigure your whole financial landscape. So thank you
Yeah.
for sharing that. This was absolutely phenomenal. Is there anything else you'd like to share with our audience? I understand you have a free gift that you'll be giving our listeners.
Oh, I don't exactly know what that is yet. Have you been talking to Lacey on that?
It's a surprise
It's a
free
surprise. I guess it's a
gift.
surprise.
And
Yeah.
so but in the past, I know that you have some pretty cool tools and pretty cool books and gifts and stuff to give away to help people really kind of dig a little deeper on this concept. So everyone, audience, the link to the surprise free gift is going to be in this email where you have watched this video. And you can learn more about Robinson by reading his full bio. And there will be a link to the Smith Maneuver website where you can reach out to all of these certified Smith Maneuver agents and really start putting this amazing practice to use today. So thank you, Robinson. I appreciate you so much. It's always so fun to talk to you. And
Absolutely. I want to say thank you very much for reaching out, Monica. I know it's been a while since we chatted, but this has been great. I want you to say hello to your family for me.
I will. I will definitely and say hi to Heidi
I
for
will.
us as well. And yeah, it's always so much fun. Every time I talk to you, I feel like my whole Smith Maneuver education just comes back full force. And I'm like, I'm gonna reread the book and I'm gonna prime the pump and do all the amazing things that you offer to get our house, down faster as well. So I absolutely love it. And thank you, audience, for tuning in. Make sure to check your email tomorrow for your next interview from our amazing speakers talking about a wealth building strategy that's going to help fast track your financial freedom. Thanks so much, everyone.